This episode of the Oil and Gas Service Podcast is brought to you by Encino Environmental Services. Now picture this. You're an operator in the oil and gas industry and you're constantly juggling the demands of drilling, production, and compliance. You're going to be overwhelming, right? Well, that's where Encino comes in. Encino is revolutionizing environmental compliance and sustainability in the energy sector. They offer emissions monitoring and tailored solutions through cutting-edge technologies to meet the ever-changing industry standards and policies. Encino offers comprehensive services such as air permitting, stack testing, leak detection and repair, environmental site assessments, and much more. They're like the ultimate support team for your environmental needs, ensuring that you're not only meeting regulatory requirements, but also setting new standards for sustainability. Here's the best part. Encino understands the unique challenges of the oil and gas industry. They know that time is money, and they've designed their services to be efficient, effective, and hassle-free, so you can focus on what you do best: pumping oil, driving growth, maximizing production. So if you're an operator who's looking to streamline compliance processes, minimize risk, enhance sustainability, go check out Encino Environmental Services. Head over to the website EncinoEnviron.com to learn more and just tell them we sent you. What's going on, Wildcatters? Welcome back to another episode of the Oil and Gas Startups Podcast. I'm here with Matt Oberdorfer from Embassy of Things. What's up, man?
Hey, thanks, Jake, for having me on the show.
Absolutely. We've had a great conversation before we started recording, so we just need to recap a few things and then clue everybody in on our conversation. So you came in from out of town. Let's start off really quickly. Just kind of walk us through, like, what is Embassy of Things? And then I think you have a fascinating story. So let's go back into all the things that you've been through, the successes, the failures, the challenges of an entrepreneur. So
yeah,
we talked about a lot of that, and I'm really excited to kind of get back into it.
So Embassy of Things, or EOT, is a software company. We call it the industrial data fabric. So it's basically the Lego blocks that you need to kind of have in place to build a digital twin, specifically industrial digital twin, industrial data lakes, cloud historians. And the company really focused on starting in oil and gas, right? So some of our biggest customers are big oil and gas companies such as BP, right? We have a lot of the companies locally here in Houston as our customers. And now the company is actually reaching out into other industries such as mining, adjacent to it, as well as manufacturing.
So did you guys have people from the team that were from oil and gas originally? Is that why it was like a target, or was it like, we've identified this problem, but oil and gas is probably the one who suffers from it the most? Let's go get that space.
So very good question. So the origin story for this company, there's basically like two core concepts. The first one, which is the more fun one, is that I had two successful exits with other companies that I've founded before. I was thinking about doing the next thing. I was sitting together with some friends, and we said, well, let's start a company together. And the main objective is to do it with people we really like working with. Mm-hmm. So that's it. That's it. That's the whole idea. We will figure out what we're going to do, but we just have to make sure that we just actually get people on board to the company that, we actually, when you have stand-up calls in the morning, whatever, that you actually like the people, right? So that's kind of a fun environment. And the people who founded companies are all serial entrepreneurs, had exits before and all success. So it was more like, hey, we really actually like hanging out with each other. We all have, done successful exits. So let's figure that out. The second part is that, I went to the dark side for a while, becoming actually a VC versus being a serial entrepreneur. And one of the most overlooked problems that all my startups went into was to actually get data out of industrial environments into their industrial analytics and AI platforms. Everybody wants to do AI. I mean, now with ChatGPT, it's like you cannot do one LinkedIn swipe or whatever with bombarded with AI. Everybody has that even in their title, right? So that's sexy, that's cool, and so on. And for me as an entrepreneur, I always try to focus on something that everybody who is going with the trend is going to need. It's kind of like, a developer is going to develop a new, a bunch of houses. It's just basically creating this. You don't want to be the fancy house there. You want to be the plumbing. You want to be the stuff that everybody's going to need. You want to be the toilet seat, right?
Selling pickaxes to the next gold rush.
Exactly. Yeah. So basically that, right? So for us and for me, what I figured out is that typically what happens when startups, AI analytics startups that go, especially in oil and gas, and say, hey, we have a product that you can do plunger optimization or, drilling bit target algorithm or whatever, some sort of stuff, right? That's all with AI. As soon as they go to a big company and they say, okay, well, we need data for it. You need a lot of historical data to train your machine learning model. You need a lot of historical data to even just do analytics stuff, right? And the big oil and gas companies say, nobody touches our data because it's secluded, it's air-gapped from the internet for good reasons. It's cybersecurity, security. So here is, we're going to FTP you some data. We're going to give you some data, maybe on a thumb drive or whatever, right? So startup goes off with a thumb drive or FTP data, and they're coming back and says, hey, we just figured out to give you, 2% of production increase or whatever. Good news, our POC will be successful. And the sad news is the POC hell is plastered with bodies of successful POCs. They're all in hell.
Yeah.
Because even though you proved that your analytics, your AI thing will actually help the company, when you go back and says, okay, let's put that into production, you still have to get the data from the operational systems continuously, probably in real time. This microphone just magically moved. In real time into a cloud service. Oh, hello. So you have to get the data moving, not just one time, not just a steady thing, but you have to continuously move it in real time into the cloud. And that is not easy, first of all, because it's disconnected from the cloud in the first place, but also the industrial companies, they buy asset, they develop new oil fields, they end of life other ones. It's not like it's like an organism that grows and goes down when there's a new wave of oil and gas. If the price of the oil barrel goes here, then we actually stop doing, producing from these wells and so on and so forth. Right? So at that point, you don't, have data, you don't need data. So you have to have a solution that actually brings the data in. So we built, and that was the second part to actually funding this company, basically the plumbing between what's in the oil field and what's in the cloud. We basically built a data pipe that you can switch on, switch off. You can actually grab data, with certain intervals. You can make and transform and enrich it so that it actually is palatable and usable by AI and machine learning algorithms, because these algorithms typically don't actually want raw data. Raw data is messy and has data losses and all that stuff. You have to kind of prepare it and clean it up, and in a cleansed state, probably also enrich it with stuff. So we built basically that system that can do that. So it's not, the first thing that you think about, hey, want to support AI and analytics, but it's a very important piece. And the truth is that everybody will love you, right? The AI and analytics company will love you because they can then share, we can put it in production. Obviously, the cloud vendors will love you because you put a lot of data in the cloud that was not there before. It's billions of records, per company per day, right? That has to be consumed, processed, and so on and so forth. And the customers themselves will love you too, because now they can actually do something in production they were not able to do before. So that was the second part. It was kind of this missing, overlooked little problem that's not as sexy as machine learning and AI that had to be solved. That's kind of.
How do you overcome? So I was on a call with a guy who is at a data management company. It's a software platform, and so they come in with EMPs or whatever, and help them really kind of wrangle all this information. A similar concept, not similar in what you actually do, but similar in kind of high level, right? And he's like, man, the biggest barrier that we have is when we're coming in and talking to some of these companies, is like a lot of these oil and gas companies just like to build a lot. They get these IT teams, and they balloon, and they like to build everything themselves. And he was like, I can get buy-in from the production department and from operations and even finance. And it's like IT's there, and they're supposed to be the enabler, but they're the ones who are actually like killing deals for us, because they're like, well, we want to do all this work. We want to build it all ourselves. So I'm kind of curious what your experiences have been there.
Absolutely.
How do you overcome that?
This is a great point. So typically our ideal customer is exactly a company that tried that and failed. Like literally,
there's a lot of them. So you're good.
Here's what happens and this is not particularly focused also on oil and gas, but also in manufacturing or in mining or in any of the other industries. In order to build a system that actually gets data in from OT to IT, if they try to build it themselves, what's going to happen is, first, let's say you have some IT data engineers that start building something in Python or whatever. Well, after a year or so, two things are going to happen. First of all, that IT guy is probably going to move on. This is the code is not. There's nobody who's going to further develop the code. It's literally technical debt. It becomes technical debt, right? And then what also happens is suddenly the requirements change and say, they say, well, instead of every hour, we need this thing to run every minute or every second, or we changed the naming convention for the tags over here. Oh, some stuff happens, and the whole thing is suddenly, it's still working, but they are like, we need to upgrade this, right? And since the people with the knowledge left, or they moved somewhere else, they're like, I don't want to touch this anymore. Please take it off my hands. Right? They're looking around for another solution. So if we come in and say we have a no-code platform that can do exactly what you need to do, and we can also scale it up to much more stuff, and we can do all these additional features, and not only you are customers, but also all the other oil and gas customers are doing the same thing with our software, which means you have a super safe, secure, and simple way to make sure that all the new stuff that comes up in the future in terms of technology advancements are also plugged into it, because you just basically receive a new version, an update that has new features in it, every month if you want, but depending on how fast you want to upgrade. So it kind of moves from a tech debt, we implemented it ourselves, to there's actually an application, a system that is a kind of industry-wide used application that they can plug in. And then it becomes mostly a pricing discussion, because they can say, oh, we can also, maybe in IT, they have we have 3 data engineers that could do this for, I don't know, in 3 months. Like, okay, and then what? I mean, it becomes more like, what's better, like long term? What's what's the OPEX like? What's the CapEx they need to actually invest upfront?
Mm-hmm. Yeah, we've talked about that for years. Of just oil companies are good at pumping oil and gas, and they should focus on that, and should not build as many things internally as possible. And there's use cases where I was actually on a call with a bunch of guys. Everybody's nerding out on the solutions that they kind of built internally, but yeah, there's certain use cases where you can very quickly spin something up, and I think it makes sense for them. But for something as complex as what you're talking about, it's a no-brainer for me to go with somebody like you guys, as opposed to hiring this massive team to support this project that may or may not work, and a lot of times it doesn't work.
Yeah, and also it doesn't scale. Meaning, if you implement something to requirements, and then if it's successful and it works for a while, then there will be other departments and business units coming out and say, hey, we want this data from over here. We want this thing from there. Oh, we want to build an industrial data lake, and we want to build it all and put it all in here. And then suddenly that Python code, either you turn the Python code in your own application, you build an internal application, or you actually build or buy, you actually buy something. So that's for us ideal. Because if you are talking to someone who's in the middle of building something, we are basically saying, okay, let's just wait for 6 months or 9 months. I mean, we are not in a hurry, right? The oil and gas business is moving at a glacier speed. It's now going, I would say the last 3 years, the glacier has become faster.
Mm-hmm. Yeah.
But it's still, it takes a while for them to figure stuff out.
So are you guys primarily the foundation of just, hey, you've got all this massive amounts of data, let's wrangle all of it so that you can go and do things with it? Do you guys have any things out of the box that you're doing in terms of whether it be, I don't know, visualizations, digital twins?
Yes.
Walk me through that.
So, we followed kind of from a product perspective, really kind of concepts that were true already, I think, 10, 15, 20 years ago, where we basically thought about what's going to be our end game, our product offering. We've started with one thing, that is the data wrangling part, right? If we can be the ones that actually are the kind of industry standard to actually get data in from OT into IT, and we have all the bells and whistles to be kind of the air traffic control system, and there's no coding involved, and and we can just roll it out to administrators. Great. What's next? Right. So next thing that we did last year is we added another solution to it, which is basically taking the asset hierarchy data, all the metadata that's attached to it, right? If you take an artificial pump, or you have maybe tanks and plungers and whatever, all sorts of stuff, right? How is that asset data represented on the OT side, right? Because you have SCADA systems, you have SCADA tags, you have historians, and so on, and you have maybe an asset management system, right? That is not in IT either. But then in IT, you also have an SAP system, and that has its own hierarchy of how the assets are structured. Yeah. So we built basically an asset management system that continuously moves in that asset hierarchy information from OT, and you can kind of merge it up with what you have in IT, and you can build new graphs. And I'm talking about really hierarchical, cyclical type of graphs that you can, manage, and these are visual, like it's kind of like a folder structure that you can kind of click through your assets and say, I want to see this pump in route 15 in areas, Permian and whatever, right? So you can click on that and then get the data from that. And you can see in the attributes, metadata that comes from a historian or an asset management system in OT. And right underneath is an SAP system or an EAM system that's there too. So we added this because it also seems to be a major pain point for a lot of those companies, that they have these two different, there's no single source of truth, right? And then the second part that we added was a product that actually does visualization. And tons of companies and also open source systems are out there, like Grafana, and there's obviously also commercial other applications out there. But what we did do is we set ourselves actually a goal to be a visualization system that's so simple that it can be used to create new dashboards and apps for the OT guys. They can do it. They can just upload a GIF or a BMP picture and say, that's my pump, and boom, 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 right? And at the same time, it has the functionality of Grafana, so that it can put in data sources like from Databricks and Snowflake and all these commercial systems, and you can build a coherent dashboard that basically allows you to interactively push interactively allow the visualization graphs to be populated from different type of source data systems based on where your context is, if that makes sense. It's basically kind of a context-driven visualization layer that, in the back end really goes down to OT systems and IT systems and allows to show it together. And it's super simple, right? So it's kind of Power BI, Grafana, and some SCADA visualization thing in one. So we added that, and that kind of concluded our whole product, right? Because now we have really building blocks that people, and they are completely independent software products. So if you already have visualization, you don't need to buy our visualization.
Yeah.
Or you do asset management, so you can just use them as Lego blocks to kind of build your industrial, digital twin.
Are you guys seeing more traction with certain parts of the market, like either upstream, whether it be with operators, whether it be the full service side,
I would say upstream.
Downstream?
Upstream is the most active, I would say.
Is there certain kinds of use cases that are trends that you're seeing?
I mean, mostly, I think what happens there is mostly production optimization, production monitoring kind of applications. I mean, I think we support over 450 different use cases, from the daily morning report, how was production yesterday, which is very simple, but everybody wants it. I mean, in oil and gas company, because it says that's how we did yesterday. And then to production forecasting, right? To tank monitoring, which is kind of a very kind of low frequency, to real-time drilling, which is sub-second data, where you have literally billions of data points coming in per day, right? So there's just tons of different use cases, but I would say the majority is really about optimizing production.
Okay. Yeah, that makes a lot of sense. This podcast is brought to you by EnergyX. Are you tired of paying huge rates to the big cloud providers? Are you worried about being booted off a cloud platform if your company doesn't meet their ever-shifting standards? Ready to step up your data security and disaster recovery game? Well, ladies and gentlemen, your new cloud is ready. Introducing XCloud, the scalable, resilient computing cloud that is also actually affordable. It's high-performance compute for half the cost. HPC for HTC. XCloud from Red Team is opening a beta program for new cloud computing customers, and that means you, my friend. The XCloud is powered by the XMDC immersion-cooled modular data center from EnergyX. I've seen this data center in operation, and it is a total game changer. So if you want more information about the beta launch, go to the URL in the description. Type in promo code BETA, BETA, for 50% off of your first instance. And so the URL is going to be digitalwildcatters.com/EnergyX. Let's talk a little bit more about your background. You and I were talking before we started recording. So you were living out in San Francisco, right?
Yeah.
Yes. So walk me through some of these. Tell me some stories about these first startups.
So my background is I always wanted to be an entrepreneur, and I have been since I was 17 out of my parents' house. And started my first company. My mom was like, where are all these checks coming from? What are you doing? Right? I was selling software, right? But in Silicon Valley, when I was in school, in college, and studied computer science, I always said to my colleagues, one day I'm gonna go to Silicon Valley and do my own startup and do the whole spiel. And I did. Ultimately, I had my company on Willow Road, which is basically really the road that goes out to Meta, where I think probably 20 years ago was Sun Microsystems. I think it was the original starting office for Cisco, small little office.
Yeah.
We were in there. And I raised, funds from $1 billion funds. Ultimately, I think this is my 7th startup. Some of them failed, some of them were successful. And so, one of the things for me is, as an entrepreneur, I just learned a lot, and some of it was the hard way.
Yeah. I think that's how you have to learn it, right?
Well, if I could do it differently, I would give myself some advice. Like, for instance, one advice I would say, in your first Series A priced round, okay, always go and try to get as much possible money legitimately, right? That you can, right? Meaning, if it says, okay, so my Series A, I don't want to give away so much of my company. I don't need $10 million. I only go for $2.5 million. I would suggest you go for $10 million. And because of the following reason, in your first round, you are in control of your entire company. It belongs to you. You have no other person there. Secondly, that's number one. Secondly, probably all or most of your forecasting and your pitch is projections of future, which is mostly a dream. It's a promise. It's a promise to what you're going to do. So there's no real valuation. I knew some companies, they raised $30 million at their Series A, right? So it depends on what you're promising, right? And so you are in that driver's seat. And thirdly, very important, any normal investor, normal being, average typical investor, will want to have 20 to 25% of your company for the first Series A. And it doesn't matter if they give you $10 million or $2 million or $1 million, they still want 20 to 25%.
Mm-hmm.
So if you get 10 million for 20 to 25%, you're going to lose the same 20 to 25% for just getting 1 million, right? So I really suggest that, in your Series A, if you can wait and actually, self-fund it, bootstrap it until you get to a point where you get a higher valuation or you get a term sheet that allows you to raise more money in your Series A, do that, right? Don't try to close a Series A fast and say we go for less money because we want to not give away so much, of the company, so much equity. So that's one.
Did you learn much about who to raise money from and certain?
So the other thing, and we talked about this earlier, is ultimately as an entrepreneur, you have to think about an exit and where you as an entrepreneur will want to exit. What I mean with this is, let's say, you would be happy with a $50 million exit. So that means you're going to sell your company with $50 million. And that's fine. You don't want to be a billionaire. You don't want to buy your own super yacht, whatever, right? You just
no sports teams,
no basket, nothing, right? So, but and you think, okay, if we sell it for 50, maybe with after taxes, I own still whatever 20%. I end up with 10 million or whatever, right? And you're like, I could live with that. That would be for me perfect, right? So you kind of make your plan. What do you think is something that you want? And of course, then you think, okay, now how does that help me with my investors? So and this is just my personal experience, suggestion is only raise funds from investors that actually where the fund size is matching or is smaller than your exit. So if you want to sell the company and you're happy with a company of 50 million, go to a fund that has 50 million fund size or less. They can also have 20 million. If you want to, if you think that you're happy selling a company for 150 million, go for a fund size that has 150 million or less. Now, why? Why is that important? It's because when the time comes for this exit and you raised money from a $20 million fund and you sell the company for $20 million, that fund will be really happy, right? If you raised money for $1 billion fund, they will not want you to sell it because 20 million is chump change. It's like not even showing up on the third zero after the comma, or after the, dot, right? So for them, their job, and this is their job as we see, is to actually return $1 billion. If it's $1 billion fund, their job is to make $1 billion unicorns, right? Mm-hmm. So if you want to sell it for 20 million, if they are on the board, which they will be because they are VC, they will not want you to sell it for that price, right? So, and there might be some exceptions, but that typically is the case. So as an entrepreneur, if you're raising money, I would suggest think about that first. Go to those investors that actually match your expectations in terms of exit, and make sure that when the time comes and there's an offer, that they will be happy and you will be happy, and the world is a better place. Now, the second part of this is that if you look at, and you can Google that and ask ChatGPT also, what's the distribution of companies and how much did they sell for, right? So you have basically a distribution where you have a lot of companies that are sold for smaller amounts, for 10 million, for 20 million, right? There are many, many, many more companies. And there are only very few that are sold for $2 billion, right? So as you pick your number, also be aware that the probability of you being successful in exiting goes dramatically down, right? You can pick a $1 billion exit because you have a great idea and it's going to be $1 billion, play, or you do a pick and shuffle play, which is basically like at some point acquired to be like tucked into some other piece, and that's a $50 million, right? These are the higher chances because somebody is going to probably have to pick you up because otherwise the competitors will pick you up and stuff like that. So I think that's some very important decisions you have to make as an entrepreneur.
So you said you've had 2 successful exits. What kinds of companies were those, and then what did you learn kind of throughout that process?
Yeah, so these were those 2. I think the experiences here is, first of all, an exit doesn't happen by itself. You're not going to just sit there and somebody knocks on your door and is like, we want to buy your company.
Hey, we want to give you money.
Right? Even though I have to say that I literally get emails every day that says, we want to buy your company. And I'm like typically putting it in a trash can. Right? Literally, I get those emails. But no real deal is typically working this way. What happens is that there is some event, meaning a company you're getting so competitive to another company that they are like, you know what, we better buy those guys because the money costs us to compete with them is higher than the price we would actually have to buy them, right? Or there's a two companies doing the same thing, they actually want to collaborate together and because they augment each other. They're not competing, but they're augmenting. Or you could be, there are companies out there that actually just buy other companies to kind of put them together, almost like a PE play, where you actually just buy different pieces and they all together become a solution. So there's always a dynamic and there's always a event. And so the tricky part is, as an entrepreneur, for me, this happened now a couple of times, is that if you are able to kind of create this event, right? And so you don't wait for it to happen. It can happen kind of naturally because you're so good and you're competing with another company, and eventually they're like, okay, we got to figure this out. Or what you also could do is you could say, okay, well, I'm raising another round. Okay. And let's say you get a term sheet and say, okay, well, with this new round of money, we are going to this additional market, or we are going to build this additional product, or we're going to penetrate this particular, customer or whatever. And if any of those steps are basically stepping on the toes of another company that's bigger than you, right, and they hear about it, they have a choice to make. You forcing a decision. You basically say, okay, well, this company here is going to make that move, that chess move. So if we let them make it, right, and they have, which they might not know, but if they get some idea that if they have that amount of money to compete with us in that space that they're going to go into, and they already have a track record of being successful in this space, then it becomes pretty much an M&A decision. It's like, do we want to actually buy them? Or do we let them, basically, do we just head on and compete with them and so on? So if you build that momentum and you kind of create this event, then in a way you kind of build a scenario where an exit kind of happens. It's not a, bulletproof recipe, but just from experience, I've seen that work, well.
Yeah. So do you feel like you come up with these strategies kind of early on, or you just kind of see opportunities and you're like, well, we know an exit's on the horizon?
That's a very good question. So I think that you cannot foresee the future. So early on strategies might be you can kind of play you can play head games and think about, oh, what if that happens and that happens. But typically what you cannot foresee is dynamics in other companies and how they react to the market, right? So there might be a company that has let's say a digital twin strategy, and suddenly that becomes a big thing for this company, and they now have to change their own strategy internally, and that means suddenly, there's these kind of gaps in their offering or in their services or whatever, and then they are starting to look around, right? So typically at the very beginning of a company, when you are really starting, you don't know that yet. The exit really becomes interesting after you became successful and somewhat, recognized in an industry. Then if you do then a step, then at that point, that step will be or should be tied to what you actually at that point see in the market. So in some way, back to your question, it's contextual and it's time sensitive. But it will still take some time. Just because you say, okay, I'm going to do this right now, it does not happen overnight. So whenever you actually get to that point and you're like seeing kind of the matrix, then, an exit or an acquisition still will take, months, because, there's this whole process involved of, how two companies actually get to that point where one says, okay, we're gonna join forces.
Yeah, I think there's another scenario that I've seen just kind of followed closely. I think it's really relevant to us. You see acquisitions like Penn Gaming buying Barstool Sports, right, for distribution. You see,
right,
HubSpot come in and buy The Hustle, right, and so The Hustle had a massive newsletter. You see Business Insider buying Morning Brew, right? So you see these tech companies that have products, right, where they're looking to get more distribution so you can have more of a negative customer acquisition cost through people who've already built out massive networks, right? And so it's just kind of like a bolt-on acquisition to help. But because now when you're looking at marketing, it's like, do I want to go out and just keep spending all this money on, Facebook and Instagram and LinkedIn ads, or do I want to go to where the people that I'm trying to reach anyways are over here on this newsletter or this podcast or this, video show or whatever it may be, and just go and buy the audience, bolt it on, and then it's like
it's a build or buy. Do you want to build this yourself, or you just buy somebody who did it already?
Yeah,
ultimately.
Yeah, exactly. Is there anything you feel like you've kind of learned about yourself as an entrepreneur? Maybe things that we talked about a little bit. I had kind of some misconceptions about what I thought I wanted to do, and then the longer I spend my time in the trenches, I think I've really just understood. I guess I have more self-awareness now to where I know kind of like what energizes me and like where I want to spend my hours in my day and like what I want to do. I'm curious if there's anything you've like learned about yourself over these years of being in the trenches with all these startups.
Yeah, I mean, from my side, I'm really energized with building companies up to a certain size. Yeah. What I mean with this is, as a small company, and we talked about it a little bit earlier. As a small company, you have one strength, which is speed. Right? You are basically in a speedboat, and you got to have an A team on board because you outmaneuver everybody else, right? So that's your strength. All the bigger companies have more money, more people, more resources that they can throw at stuff, but they're going to be slower. They're like oil tankers or bigger ships. They're like, So the second part that you need to do is be like a laser-focused sniper. Right? If you do a marketing campaign, you cannot just throw like, we're going to do a big, marketing launch and blah, blah, blah. We're going to go to this show and have a big booth, and to this show and go to a big booth. Even if you have a lot of money. But that's one thing that I also learned, when I raised, a lot of money from really big funds. If you then go and say, oh God, we're going to have a big booth, with our own setup, design, whatever, right? Not effective. I would, as a startup, even if you have money raised, I would not do it. I would really literally look where is your ideal customer? It might be a small little seminar room, in Houston, where they discuss with petroleum engineers something, versus having a booth at the offshore technology conference that happened just a few weeks ago, right? Where if you buy a booth there and you spend $100,000 on that freaking booth, you might get way less customers than if you go to one of the smaller things. So you have to be extremely focused and think about how you get there. In terms of, so back to this, for me, that is something that inspires me and where I'm feeling passionate about, right? Because when I have a team and work with customers and also partners where we can build that up, you're really a close-knit group of friends or people that are in the same adventure. Right. Mm-hmm. Once it reaches a certain size where the company is, let's say, beyond 50 people, 70 people, and it becomes more like a process where you have this department and that department, and this department had outsourced and agencies and outsourced people here and here and here, and you kind of lose the speed and you kind of transfer into or convert into kind of like a big company, but on a small scale. And that then starts growing and growing and growing. That's for me at that point where I'm like, okay, this is it's a different day of a life of an entrepreneur, because suddenly you're not really, sitting on your speedboat. You're on a bigger boat, and you have to be more strategic, and you have to, organize all your people that they do the things correctly, which you also have to do in a small team. But at some point, the agility goes away, and so for me, that's when it becomes kind of less interesting. Mm. That's all.
No, I 100% agree, man. I think we've been very much in this like 0 to 1 phase for a while for Wildcatters, and it's cool. Now we're kind of starting to get our legs beneath us and kind of starting to like go into like growth, and it's cool to see how things have like transformed over time. For so long it was just like a handful of us, kind of shooting from the hip, doing the cowboy stuff, and now it's like, we got like systems and processes. We got more people.
Yeah, and then building this is the cool thing, I think, because ultimately that's the foundation that all the rest will run on. Right, that's when you set the culture of the company.
Yeah,
that's when you bring key people on board. It's so critical for hiring the right people in the early phases. I mean, if you have 50 people, you hire one person more. It's a 51st percentile, right? Or 1 out of 50 percentile or 51 percentile. So it becomes, in terms of what can go wrong, it's different than if I hire the 10th employee. Right? Yeah. If that if it's the wrong choice, then a 10th of your company is invested in the wrong thing. Right. So it's
a big deal. Well, Matt, I know you gotta run to this next meeting, but I really enjoyed the conversation both here and then prior to us getting on the mic, and enjoyed having you in town. And thanks for making it. And I would love to catch up with you later down the road and see how things are going for you guys. Where can people check you guys out? What's the website?
So simple website for the company is embassyofthings.com. You can also go to industrialdatafabric.com if you're interested in the solution. That would be it.
Awesome, man. Well, I appreciate it. If you guys like the episode, take 2 seconds to rate and review. Share this with all your colleagues and your friends, and we'll catch you guys on the next episode.